With massive layoffs in nearly every sector, weakness in manufacturing, car sales and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone, and welcome back to Stansberry Research, where we continue to quickly follow all the breaking news from the banking crisis. Joining me now for the latest is Simon Dixon, founder of Bank to the Future. Simon, always good to see you.
Yeah, it's been a wild one since we last spoke.
It has, and look how much has changed and happened, and I couldn't wait to do this right now with you. But Simon, let's talk about all the lifelines being given to the banks right now. And of course, then we'll talk about the greater issue at play of how close are we, and if we are, to a broader financial crisis. But first, your take on the lifelines that these banks are being given.
Yeah, I mean, so we forgot about free markets a long time ago. You know, we've been in a quantitative easing market ever since the 2000 dot-com boom and bust, and then the 2008 financial crisis. And now we've got the, another version. Historically, every 10 years, we get something like this. But what has really been exposed is the fragility of the financial system when you try and, reverse any kind of centrally planned low interest rate, central bank or government subsidized stock market. And so what we're seeing right now is that the impact of putting up those rates to something that would be more akin to a free market, no matter how hard the Fed tries, no matter how hard, you can't really, you have these breaking of things. And it turns out that banks have been broken, crypto banks and Silicon Valley banks and hedge fund banks, based upon a product that has become more volatile than Bitcoin, which is straight up treasuries.
Yeah, I mean, there's a lot to unpack there, but first let's talk about the lack of risk management at the banks. I mean, does this not bewilder you, Simon? I mean, I just want to bring this up. Wall Street Journal also reporting that top execs at First Republic sold millions of dollars of company stock in the last 2 months, but they didn't report the sales to the SEC.
Yeah,
How is this criminality going on?
Yeah, we've seen that in both the Celsius and crypto banks and FTX and everything, and we're also seeing it in the traditional banks. So it appears that the ethics and criminality of jumping off of a sinking ship just before it sinks is something that seems quite universal with all of these epic failures. And so, they can't do it with honor. So they end up taking out their money and making sure that they're okay, to cover all of the legal fees and investigations that's probably going to come after it. So I just hope that financial crime becomes something that is better punished in the United States, because, we even saw it in the crypto cases like SBF and FTX. When that immediately happened, SBF was in prison in Bahamas. The funds were seized and they were safeguarded with the regulator. As soon as they made their way over to the US, the Chapter 11 was spending $65 million of client money a month on legal fees, and SBF was out of prison in Palo Alto. So we seem to have a theme here. And really, that is what I think one of the big regulatory failures that we've seen in the United States as well, is that they seem to treat it as an opportunity to fine rather than prevent the crime in the first place. And we even just saw a $260 million money laundering scheme get busted with NatWest Bank in the UK as well. So it's all coming.
I can understand, not that I can understand, but the banks, the regional banks, the smaller banks, you can almost say, okay, they were definitely sloppy. But when you're talking a Credit Suisse, the second largest bank in Switzerland, what went wrong?
Yeah, so if you're looking at, you've got several different cases that appear to be interrelated, and then you have the perfect storm when everyone is at maximum fear at the same time as information flowing faster than ever before. To put it in context, the largest bank run in history, Washington Mutual in 2008. It took a week or so for $10 billion to be withdrawn. With Silicon Valley Bank, it just took one influential VC to say something on Twitter, and $42 billion is wiped out within a 24-hour period. And so no bank can sustain that at all. With Credit Suisse, really it's been a zombie bank since 2008. It's had disaster after disaster. And so it was a bank that was meant to fail a long time ago, but it appears that they've been given these additional lifelines because of their too big to fail nature. Each one is fairly different, actually. So you've got Signature and Silvergate, which were affected by having too many deposits in a market that was growing really fast, the Bitcoin and crypto market, and then not being able to deploy loans. And so therefore they ended up investing in mortgage-backed securities and treasuries that were paying a very low yield. So when they hiked the rates, suddenly their assets crashed. They have to meet deposit needs, and they have to sell those assets at a discount. They couldn't raise the equity fast enough, and they locked in a $1.8 billion loss, and it broke the bank. In the case of Silicon Valley Bank, 97% of all their customers were businesses, tech companies. And so therefore, the $250,000 FDIC limit only meets a few payrolls. And so they had this, this situation where all of the large tech companies had their deposits there in order to secure their VC funding. And so a couple of hedge funds, a couple of VCs withdrawing as a result of the same situation, the same distress, caused a big bank. Now with First Republic, we've got all the hedge funds were there. And with Credit Suisse, we've just seen a zombie bank. But pull all that together, and I don't think Credit Suisse was even related. It was just awful timing. Pull all that together, right. And you have the perfect storm where the FDIC comes along and has to say, right, we'll backstop all deposits.
So, few questions here. One, we saw Treasury Secretary Yellen and President Biden coming out saying, no, let's not panic here in the U.S. Our banks are sound, but yet definitely there's a loss of confidence in the bank. People are pulling out their cash, worried about who is next. What's your take on that? Are those fears, well, obviously well-deserved, but what should folks be doing here?
I don't see, famous last words, because in scenarios like this, there's famous quotes, obviously, when things go wrong. But it's either one of those problems where we're all screwed as opposed to just a few people being screwed. And so, one bank is what we've already seen, whether it be Silicon Valley Bank, a completely niche bank, because it causes that panic and because things can break out on Twitter at such a fast pace, it affects the whole system. So, you either in a situation where all banks are going to be, gobbled up by the larger banks, or it's probably not going to be one or two that go down. In 2008, it was they were picking, well, essentially BlackRock was picking the winners and losers as advisors to the Fed on picking which banks to allow to continue, and then the Fed was lending money to JP Morgan in order to acquire like Bear Stearns. I don't think you end up in a scenario where, either all banks are in trouble. They've already said we're not going to be picking winners or losers. So they're backdrop in the whole thing. And really, the entire banking system is 100% a function of the credit rating of the US government right now. And so that is really all you're analyzing, because they've said we'll continue to print money. And I think they're using the fact that historically, the most deflationary event you could ever imagine is a bank failure. So I think that they're leaning into that in order to try and return back and reverse back into a quantitative easing cycle, and control inflation.
Well, now that you bring that up, Simon, we're speaking ahead of the Fed here, and they're obviously in a very difficult position. I would not want to be Fed Chair Jerome Powell right now. I mean, what is the Fed to do? Continue the fight against inflation, keep raising interest rates, or deal with the bank crisis and say, hey, we need to pause here? We saw the ECB continued raising rates. Will the Fed follow?
Yeah, it's the impossible decision. And, we saw the ECB really, stick to their guns and really take the flex move, which is to stick to the half a rate hike, really signaling that inflation they see as a bigger risk because they think that this is really, a deposit insurance issue as opposed to anything else. But I think, we've seen the market price in differentials. I think before all of this happened, just last week, it was a dead cert that we were going to have a half a point hike. It's either you can't really do every decision has its bad merits. If you don't do any hike at all, then that they're not serious against inflation and they are politically able to change policy based upon political needs. If they stay at 0.5%, then that actually makes the problem worse for the banks because it increases the exposure. So I would predict that we go for a half measure where they say we're committed to inflation, but given the fact that CPI printed 6%, they're going to use that reason as saying we were going to go from 0.5% to 0.25% anyway. So my money's on 0.25%. I don't think you'll get what they were going to do.
I guess as someone who's not part of the traditional banking system, Simon, what's your advice to the folks watching? I mean, would you be completely out of the system?
Well, I've never held more than FDIC insurance level at a bank, and I only hold it. I don't really see money at a bank as my money, so I risk manage it accordingly. That is, I've been involved in Bitcoin since the early days. You always have to give a tremendous amount of data just to be able to transact. And so, since anti-money laundering laws have got so aggressive, legitimately earned all my money, but I have to prove all my money in order to, try and get access to it. So for me, money at a bank is just really money that I'm lucky to get back is how I've always thought about it. And obviously that's not how most people think about it. So I've always been prepared outside the system. I think that Bitcoin is a great mechanism for savings, but it's not very useful for spending, because if your costs are in dollars and your savings are in Bitcoin, then you end up a trader just to manage your expenses. So, people do need to hedge, and they do need to understand, because the reality is, throughout this whole system, Bitcoin has just worked. One of the major risks to this as well is that people don't keep more than FDIC insurance and, a $250,000 level, and they put the rest in treasuries. Now, there's quite interesting questions, because there have been banks that have been trying to launch the ability for you to have an account, backed by treasuries, so that you don't have to take bank risk. The interesting conversation is a full reserve bank, as it were, backed by the credit rating of the US government, is in fact a systemic risk to the system, because there could be a flight to safety, which takes down all the other banks, which then brings us into where I think this all games, or where this all goes. And we've talked about this many times, but all roads lead to the central bank digital currency in the end, because these events don't go away, and they will eventually be replaced once the technology is ready, where you no longer need your bank. Your bank can go bust. You just download a wallet with the central bank, and we don't have this this game of trying to manipulate interest rates. It's just one money supply with a central bank digital currency, and because of all of the problems that can cause, you need gold, you need Bitcoin, and you need exits from the system in that world that I think we're headed to.
When you say that's pushing us in the direction of central bank digital currencies, do you think this is part of a planned narrative or just happenstance?
Take your pick. I don't like to assign intent, but when you run a debt-based fractional reserve system, history has shown that every single cycle, every 100-year cycle, historically, a currency only lasts about 50 years. So we're definitely on the longer side with the US dollar. The longest one we had was GBP, but they always end in the same way, which is that they hyperinflate, and then a new type of currency and a new monetary policy steps in. And so at some stage that is going to happen. My forecast is that will happen in my lifetime. And I don't think it's necessarily that a grand scheme plan to launch a central bank digital currency came through. But it is actually the last monetary policy tool in an environment when you're choosing between inflation and recession, which is where we are right now. That's the only choice.
I wanted to bring up an article, and I was kind of surprised to see this news this quick, and I don't know if you saw it yet, Simon, but the Fed, and this is Yahoo Finance put it out, the Fed to launch instant payment service FedNow in July. They said it would launch its long-awaited instant payment service. The instant payment network will settle payments in seconds with the capability to support consumer to consumer, consumer to merchant, merchant to merchant, and bank to bank transactions. With the FedNow service, the Fed is creating a leading edge payment system that is resilient, adaptive, and accessible. Thoughts on this, Simon?
Yeah, I mean, this is, the beta launch, really. I haven't dug deep into the privacy implications. I know that there's been several bills out there to launch an e-cash, at the Fed level, which would operate in a pseudonymous way similar to Bitcoin. But my guess, this is a central database that is really a pilot program. So if you look at China started their central bank digital currency in 2020. They slowed down development in 2018, but when Facebook announced that they were going to be launching the Libra project backed by a basket of currencies, and they missed out the Chinese yuan, China decided that that was the time to get their pilot central bank digital currency moving. They've now in China, there's 250,000 wallets. 1.7 million people already have WeChat Pay, so they lead and dominate in digital payments and fintech around the world. And they've already integrated it with WeChat Pay and Alipay, and so they've done about $15 billion of transactions in beta. I think this is the US trying to catch up. The executive order did say that they need to look into the central bank digital currency and FedCoin. So I personally believe
it's real.
that it's a national security thing that you have to do, because it's the ultimate way of allowing a bank to go bust and replacing it without people losing their deposits, exactly as we see right now, but without doing it backed by debt. So it's more deflationary.
Yeah.
It meets all of the government's goals. It allows them to control people's money. It meets all those agendas. The problem is the impact it has on personal freedom, liberties, and everything, and it's unconstitutional, quite frankly.
I want to go back to a point you made about whether the dominoes will keep falling in regards to the banking sector and whether the big guys will be brought down. I mean, we often hear this can't happen to a JP Morgan, whatever, TD, BMO, take your pick. Is it naive to think that?
Well, it can happen eventually, but the big winners of this will be the large banks. So, the correct solution when a bank goes bust is not for the FDIC to backstop it. It is for the free market to come in. So JP Morgan did that in 1907. issued lines of credits to failing banks, bought up the equity for pennies on the dollars, and bailed out, and it consolidated into the larger banks. In 2008, a similar thing happened, but it was more crony capitalist. The Fed decided to lend money to JP Morgan in order to acquire banks, and it wiped out some of the shareholders in banks like Bear Stearns. Right now, the Fed has come along and saying, we'll backstop the bank, and JP Morgan can now come along and acquire many of these banks. And we've already started to see announcements, I think in the last hour or so, with First Republic as well, that a consortium of banks are coming in. So as soon as the Fed says we'll eliminate all the risk, JP Morgan will come along and say we'll take all the upside.
I want to turn to Tether now. You've been coming up in a few Twitter spaces. I know you've come under fire for some comments, and I want to give you a chance to respond. Basically, if I'm summing it up correctly, in the past you had said Tether had 850 million seized for bank fraud and money laundering through no fault of their own. And then the Wall Street Journal put out an article that crypto companies behind Tether used falsified documents and shell companies to get bank accounts. I know some other experts out there have had harsh words for you, Simon, saying, calling you everything from a fake for your comments and whatnot. I just want to give you an opportunity to respond.
Yeah, well, I'm the guy that has invested in over 100 companies. And whenever there's a disaster, I'm the person that gets called. We've done commentary on the Celsius situation. I couldn't give two damns about Celsius, but I was trying to put together a restructuring for the depositors. The same was the case with Bitfinex and Tether. So Bitfinex was about to be statistically problematic for our industry. And so we did a restructuring, and that's why I'm a shareholder in Bitfinex, where we filled the hole from a bunch of hack coins. We allowed the exchange to continue so depositors don't lose money. We implemented free market solutions rather than needing FDIC for that. I was also partially involved in doing the same for Tether when $850 million was, and it's both of the stories are still exactly right, by the way. So they had to use, because the banking system wouldn't allow them to use their rails, when Wells Fargo back in 2017 decided that they weren't going to support through clearing of Taiwanese banks that Tether was using at the time. They had to use almost like shadow banks in order to maintain that service. Now, one of those shadow banks was Crypto Capital. There's no secret here. There's nothing new here. They had a bunch of their money seized. And from all I know, it had nothing to do with Bitfinex. It was a bunch of banks, and Crypto Capital was involved in all sorts of stuff. So it's like blaming you for you using a bank, which turned out to be a shadow bank. It's one of the risks of the partnership. Again, I'm just a shareholder, so I don't have access to any inside information. I just know that. And in terms of shadow companies, this is a function of a company that needs to set up different companies to gain access to the banking system so that you can process payments in an environment where banks are very regulatory hostile. It's going to happen with all the crypto companies right now. Now that Signature's gone, now that Silvergate's gone, now that Silicon Valley Bank is gone, they're all going to be looking for alternative ways of allowing people to offboard from the fiat system into Bitcoin to give people an exit and a lifeline when banks go bust. And so I don't put my reputation behind it. I just say exactly what happened. And I'm a shareholder in over 100 companies because, the particular with Bitfinex, it was because I was trying to support creditors from losing their money as a result of unfortunate situations.
Yeah, I appreciate you answering that. And like I said, I do feel it's part of a broader conversation. And Mark Cahotis, a guest of mine recently who, has called you out publicly is happy to have a toe-to-toe on this discussion with you. I'm happy to moderate it. Just putting that out there for you to think about, Simon.
Okay, why not? I mean, the only thing we ended up in an altercation is because I just simply mentioned that there were other security token exchange companies other than T0. And for some reason that caused a lot of offense. And since then, he seems to have decided. So no problem. I mean, if we're here I'm more than happy to talk about things, nothing to hide.
Just final thoughts. Like I said, and offline, actually, I love the conversation we were having, Simon. You brought up, and you nailed it when you said that things are just moving now at an amplified speed. That's exactly how I feel. I was telling you, I feel physical pain from the amount of news that's being thrown at us. And unfortunately, you think this speed is here to stay. Don't tell me that.
Yeah, I mean, things just seem to be moving faster and faster and faster. I think humans won't be able to keep up, and it really is a part of the whole technology and artificial movement as well. I think at the next phase, it's going to be artificial intelligence running our central bank digital currencies, and that's why it's so important to have proof of work blockchain so that we can maintain some of our freedom. But I don't think the pace is slowing down from here, and I think this is a sign of what this world looks like at this ever-increasing pace.
That said, given the pace we're moving at, final thoughts for the viewers at home, Simon. How should they be navigating these times? What should they be doing? They're looking at their, the cash in the bank now. I mean, things they should be thinking about, small things maybe they could do to make a change, anything.
Yeah, I mean, if you've got less than $250,000 at a tier one bank, then you just need to think about the risk of those banks. It's all about risk management. Unfortunately, we all have to be portfolio managers just in our everyday life. And that's why the importance of staying up to date with education and videos like this. It's just like the stablecoin conversation. Last time we spoke, I said, you've got a risk of a stable coin that is regulated by the US, which is a different risk to the stable coin that's regulated outside US. And that actually turned out to be true. A bunch of the money came across.
That's right.
And so same with banks as well. You've got a risk of a small regional bank versus the risk of a large, too big to fail bank. They're both risks to manage. Then you've got the risk of, treasuries and investing in your government. But the most important thing from my perspective is to have your exit portfolio as well. And so over the last decade, I've always, every single month without fail, converted some of my fiat to Bitcoin and make sure that no matter what happens in the system, no matter where it goes next, I still have the ability to own my own money, spend my own money, and I have a force against, the inflationary pressures of many of the unfortunate situations that politicians and central bankers are going to need to make in their impossible fight between depressing the economy and inflating the currency.
Correct me if I'm wrong, but you're also in gold, right, Simon?
So I do a dollar portfolio, I do a gold portfolio, and I do a Bitcoin portfolio.
Okay, thank you. Simon, I appreciate you joining me today. I think we managed to cover quite a bit given the time we have, and I want to thank you. Thank you.
Okay, thanks for having me. Look forward to the next one.
Me too. And thank you all for watching. We'll have more coming your way, so be sure to stay tuned to the Daniela Cambone Show and sign up at danielacambone.com so you can stay on top of all this lightning speed news coming our way. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.